Monochrome Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monochrome.
Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Great to have you with us here at Ausbiz. Well, let's check what happened on Friday, how we rounded out the week. Global stocks mostly lower on some mixed economic data. On Wall Street, tech stocks weighed down the broader market. The Dow edged higher, helped by a climb in McDonald's shares. Now, for the week, the Dow was up 1.4%, the S&P rose 0.6%, while the Nasdaq was flat. Nvidia was one of the biggest market movers on Friday, while semiconductor stocks Qualcomm, Broadcom and Micron Technology all fell. And shares of other mega caps were mixed. Spirit Aerosystems jumped higher on a report that Boeing is nearing a deal to buy back the airplane parts supplier. And shares in Sarepta Therapeutics soared after the US FDA allowed it expanded use of the company's gene therapy for patients with muscular dystrophy. Well, US business activity climbed to a more than 2-year high this month as employment rebounded and price pressure subsided in a sign of cooling inflation. Both manufacturing and services PMIs rose more than expected and are solidly in expansionary territory. However, retail sales barely rose in May after falling the previous month, and housing starts extended their decline, hitting the lowest level in almost 4 years. In the Eurozone, PMIs were weaker with manufacturing in contraction, and in the UK, PMIs were mixed with both manufacturing and services in expansion, while retail sales rebounded in May. And US Treasury yields were little changed on Friday, with the 10-year at 4.25% and the 2-year at 4.73%. And the US dollar edged higher against most major currencies, hitting an 8-week high against the yen. The Aussie trading at 66.4 US cents. Well, high interest rates, sluggish domestic demand and shrinking exports are hurting stocks in Southeast Asia. Central banks in the region are caught between supporting the local currency and supporting their economy. We'll discuss that dilemma with Arthur Budayen from BCA Research.
I think when we look at ASEAN economies, Southeast Asian economies, what comes to mind first? How weak the domestic economy is. And when we try to understand the reason behind that domestic economic weakness, the most important variable seems to be interest rates. Interest rates are too high, especially in real terms. Interest rate deflated by inflation are quite high, that is hampering expansion of domestic demand. So what has happened in the past couple of years? Those central banks hiked interest rate, tried to match with Fed, and the inflation has fallen quite a bit. Inflation is low, but they have not reduced interest rate because they're trying to not to be too far ahead of Fed. As a result, real interest rates are very high for domestic economy, and domestic demand is rather struggling in those countries.
Okay, so they're essentially trying to support their local currencies. That therefore is impacting economic growth. I would have thought it might have. Let's focus on exports. What's happening as far as they're concerned, given those high interest rates?
Export market is doing okay, but not really well. Depending country, export growth either mildly negative or mildly positive. If we have to summarize, overall exports are not contracting, but they're not growing, basically flattish. And going forward, risk is that ASEAN exports will start contracting, consistent with a renewed down cycle in global trade manufacturing. So export sector is not going to lead these economies out this growth slump. So I think all hope should be on domestic demand, but domestic demand is not responding because of higher real interest rate.
Arthur, what does history tell you about efforts to support a currency with high interest rates?
My experience with emerging market for past 25 years has shown that any time when domestic fundamentals are weak, domestic growth is weak, and central banks trying to run hike interest rate, or keep interest rate at very high level to prevent exchange rates from falling, it doesn't work. Because in emerging markets, the prime driver of exchange rate is not interest rate, it's domestic fundamentals, strength of domestic economy, return on capital, and so on. So if domestic economy is weak, keeping interest rate high or hiking interest rate is going to have a negative impact on currency, not positive. And we have seen Indonesia trying to hike interest rate, do this defend currency, and currency is falling rather fast. So high interest rates are not going to be sufficient to keep currencies from depreciating.
So, what do you see for those economies, particularly the ones that rely on exports?
I think we're going into a meaningful downtrend in those economies where exports are going to be weakening. And second, domestic demand is going to stay sluggish or even weaken further. As a result, these ASEAN, Southeast Asian economies are going to enter kind of a very weak period, business cycle downturn, and the currencies will depreciate, and kind of stock markets will underperform. At some point, when economy is very weak, central bank will realize that there's no other way to help the economies but to cut interest rates, and they will start cutting interest rate. Is not imminent, but I think eventually by end of the year, these central banks will be cutting interest rate rather rapidly.
Arthur, which economies in particular do you feel are at most at risk at this point?
I think most of the risk is Malaysia, because Malaysia is the most open economy among four, and we're discussing about Thailand, Malaysia, Philippines, and Indonesia. Among those four economies, Malaysia is the kind of most vulnerable, because exports is very large share of Malaysian GDP. Plus, Malaysia has many problems that accumulated over the years, and that these problems have not been solved. So domestic demand is very weak, and external environment going to be negative for growth in this country.
So, from an investor perspective, then, how should you be positioning, particularly in relation to equities?
I think when we look at equities, apart from domestic growth or GDP trajectory, it's very important variable what's the valuation look like, whether the market is expensive, cheap. And when we look across four stock markets, we overweight Thailand, we neutral on Malaysia and Philippines, and we underweight Indonesia. Why? Because Indonesian bank stocks have gone up a lot, and we believe Indonesian currency is weak. Even though GDP-wise, economy is not going to be slowing as much as Malaysia, but in terms of a financial market, Indonesian market seems to be a bit more vulnerable than Malaysian market. That's why we're underweight Indonesia, but neutral on Malaysia, Philippines, and we think that Thailand kind of offers relative safety on a relative basis, not absolute basis, among those four countries in terms of equity market.
So, overall, Arthur, then would you be avoiding those emerging markets in Southeast Asia and perhaps focusing on other emerging markets?
Yes, at this moment, we're not positive on emerging market overall in absolute performance, and we're not positive on the Southeast Asian countries' absolute performance. Yes, for absolute return investors, we don't recommend allocating capital to Southeast Asia at this moment.
Overall, when you say you're a bit reticent just as regards to emerging markets, what needs to change then to change your opinion?
The primary driver of emerging market stocks is corporate profitability. And the reason emerging markets have been performing so poorly because in past 15 years, corporate profits in emerging market of listed companies has been flat. So for 15 years, no growth in corporate profit with a lot of volatility. Investors don't like flat profits for a long time with a lot of volatility. Investors like upward trend in profits with little volatility. So the key reason why investors were leaving emerging markets is not because of anything but corporate fundamentals, domestic fundamentals. And for me to change view on emerging markets, I have to see light at end of a tunnel, at the end of a tunnel for corporate profitability to improve and corporate profits have an upcycle. Hopefully, it will be more than a cyclical upturn. But at this point, we don't see even cyclical upturn in corporate profit. So bottom line, corporate profit what matters, and I don't see major improvement in corporate profit over next 6 months or so.
Arthur Budoyan from BCA Research with his outlook for Southeast Asian economies and stocks. Well, let's take a look at what is ahead locally this week. We've got Westpac Melbourne Institute Consumer Sentiment Index released tomorrow. Wednesday sees a monthly read on inflation with May's CPI data, all important. Thursday, job vacancies for May are released, while we also get a measure of household wealth for the March quarter. And RBA Deputy Governor Andrew Hauser speaks. And on Friday, private sector credit. Overseas, Tuesday sees US consumer confidence for June and home prices, along with the Richmond Fed Manufacturing Index. Thursday, US economic growth data for the March quarter is released, along with wholesale inventories and durable goods orders. China industrial profits also released. And on Friday, out of the US, personal income data, along with May's PCE core deflator and the Chicago manufacturing PMI. Stay with us. We are just a couple of minutes away from the open.